Morning, everyone. Thank you for joining us on this Tuesday, first day of the week. I hope everyone had a good long weekend. Today we're going to do a little bit of a different session from our normal monthly. You'll be hearing significantly less from me and a lot more from my colleague and head of credit, Corneleo Keevy. I will just spend 5 minutes on one or two slides, and then I will hand over to Corneleo. I would highly recommend you ask him a lot of questions. He's very knowledgeable about credit and space in both this listed debt market as well, the unlisted debt market, and even the syndicated bank loan market. We're going to run through a quick fund performance update, and then we're going to do a credit update and understanding default events. So from a performance perspective and from a fund performance perspective, I think this is the first thing that everyone needs to be familiar with. It's just a one-year chart of the US 10-year. And we can see the US 10-year bottomed out at effectively below 0.6% in July and August. Then it spent some time between 0.6 and 0.8 up until October. And from then on, borrowing costs, depending on whether you use the 0.5 in August or the 0.6 in September, or the 0.8 a little bit closer to November, borrowing costs have either doubled or tripled for the US, going from 0.5 to 0.8 to currently sitting with this morning at 1.65. And this dynamic, this increase in US rates, which also is US base rates and international base rates, is what's led to the range of performances that we've seen over the last couple of weeks and months, not just out of the US bond markets, but also emerging market assets, SA assets, as well as equities. It's driven a underperformance in many of your high momentum and high growth stocks, because those stocks by their nature tend to have, if you want to calculate a duration for them, would have a higher duration, or to put it differently, a higher sensitivity to interest rates. The reason for that is growth stocks tend to have more of their dividends and profits further away from the current period. Therefore, they are more sensitive to changes in interest rates. Your more value stocks and things trading in higher dividend yields and earnings ratios are less sensitive to those moves. So we've actually seen that some of your other smaller companies and more value companies have done well over the last couple of months, where some of your bigger companies, especially some of the very well-known companies that were well known for doing exceptional last year, things like, for example, Tesla, have actually sold off from their peaks. Tesla peaked at, I think, a little bit above $850. It was trading close to $600 a couple of weeks ago. It was down over 20% at one point. And this change in the US rates, as I've said, is what's been driving performance globally. So let's just move ahead quickly, just to give you a broad funds overview. The Ashburton Money Market Fund is performing in line with expectations and peers. For those unfamiliar with it, it's a money market fund run much more in line with the corporate money market fund. It has no corporate credit outside of the big five South African banks, some treasury bill exposure, and AAA rated international banks. So it allows for investors to have a conservative investment option without any corporate credit, and hence make that credit decision on their own. Stable Income has had a very strong last 6 months, and longer-term performance numbers there are also good. Over the last 6 months, the Stable Income did about 2.7%. That's a bit above 5.5% annualized. So we're very happy with the performance numbers there. SA Income performance is lagging a little bit versus peers, but is still outperforming its benchmark nicely over short-term and longer-term periods, with the exception the 1-month numbers are a little bit low because of the rise in rates. Moving ahead, if we go to the bottom end, the Ashburton Bond Fund is doing well over shorter-term periods as well as longer-term periods. And Diversified Income has had a difficult February and a little bit of difficult March thus far. But if you look at 3 months, 6 months, 1 year, and longer term numbers, those numbers are still good. As of the end of March, we'll have a 3-year performance history, which we will also be able to include here. And we hope to be able to see many of you in discussing this portfolio specifically going forward. We do still feel that this multi-asset income space is probably where there is the most value. This space and the low equity space is where we think there's a lot of value for clients, specifically for those clients that traditionally sit in money market and conservative solutions. Moving to something like a multi-asset income is likely going to give them a better 12 to 24 month return profile than being in, say, money market portfolio. I will remain on the call if you have any other questions around the markets or anything else. But if there are none, then I'm just going to hand over to my colleague Corneleo, who's going to do a credit update as well as an update about some other credit issues. I would once again recommend that you ask him questions in the chat. Thank you very much.
Good morning, everyone, and thank you for joining us. Yeah, so as Albert mentioned, we'll start off by just having a look at the general credit market, some of the supply-demand drivers that are sort of pushing credit spreads at the moment, and then if we'll close off with a look at a little bit of an update on the land bank, which is obviously a very topical name at the moment. So if you look at credit issuance, it really is a story of 5 years of or if you look at the credit market over the last 5 years, it's been a story of strong real returns because of your JIBAR rate, which is the floating rate, which is the base rate relative to which majority of credit is issued in the market, actually delivering a real return. And we saw a lot of uncertainty in some of the more established asset classes such as government bonds and equities. And as a result of that, we saw this massive demand for credit as an asset class in the South African CIS space specifically as well. And in response to that, there was quite a bit of issuance in the market. And then what happened was 2020 came around, COVID came around, and the market really reacted strongly to, I suppose, the uncertainty that was created in terms of the financial results of all the issuers that are issuing credit. And you can really see that in the first 2 slides, or in the top 2 charts there, where you can see effectively the markets closing in April and May 2020. And then again, and that was really leading into that first lockdown. And then again, as we were approaching the second wave, and we had the second lockdown, December, January issuance, and January 21, it's also being very low. And what that really resulted in was 2020 overall, in terms of issuance, being at about 92 billion rand, just over 92 billion rand, representing a 47% decline year on year in terms of issuance, and being probably one of the lowest years of issuance in at least a decade. Now, where did all the issuance go? If you look at the main reduction in issuance, it was in the bank senior secured space, where the banks, just given they probably limited the appetite to advance new credit in this environment, there was a limited need for them to raise additional funding, and that's why you saw that really big decline of 70% of issuance year on year. And that's typically the sector of the market that accounts for probably the largest share of issuance consistently over the last few years. We also saw corporate issuance declining 44% year on year. I think there again, firstly, uncertainty around the South African credit market and just the ability to actually place paper on that market. But secondly, also, the corporates, a lot of them still fund themselves mainly through the large South African banks with funding rather than the capital markets. And during such times of uncertainty, I think a lot of the banks opted to go to their more traditional bank funders to refinance some of their debt obligations that were falling due rather than looking towards the capital markets. We also saw, and it's not on the slide, but we also saw about just over 40% decline in SOC issuance for the year. Interesting development during this time. So we saw the capital markets starting to open up in sort of June 2020, and then it took us almost, it took till August for an actual auction to be held for the issuance of a listed credit instrument. And we actually saw that between May and December, in excess of 90% of all listed credit instruments were actually placed on a private placement basis, which means it wasn't. It's really done with one or two investors, and I think what that really is, once appetite for credit did return to some extent, and we could touch on why that happened, there was limited credit available in the market. So just what does all this mean? Is that we've had a massive increase in the AUM in the South African space that looks for credit assets, but after a year like this, you can actually see that your listed or your investable listed credit universe is declining. It's declined 5% year on year, and effectively what that does is there's not enough credit being issued to even replace maturing instruments. So if your AUM is standing still and you're not actively looking for new credit, you are still in a difficult position to deploy credit to eliminate the potential cash drag, just because there's not sufficient new instruments to maturing on your book. Look, we also had a look at has the market repriced? This is a very basic exercise we did, just looking at all floating rate notes that were in issue in the middle of March 2020, as well as what's still in issue now to the latest available date. And we said, well, of those instruments, which of them have had some level of mark-to-market movement? And then we also said, well, which of them at any point during that year repriced by more than 10 basis points up or down? And you can, and really that's for us to determine, or for us to see, well, has the market repriced for the impact of COVID, and to what extent do we think that is priced in? And you can just see from the top three lines there that the bank paper, true to form, was the most liquid in the South African market, and that is something that we've come to experience over the last number of years. So that's why we're not surprised to see that that's a market that repriced quite significantly as a share of the investable universe. And then the same with insurance company issuance, corporates and SOCs. But even so, what we've also done is, just because of the slightly different way in which corporate paper and the property issuance behaved, we split that out. But you can see even in those sectors that are less liquid, there was a level of repricing that we haven't seen in a long period of time. So what we've done here then is to say, well, if something has repriced, or if something was in issue in the middle of March last year and it's still in issue this year, what we've just done is to calculate a simple weighted average spread, and we've based that to 0 to see how did spreads react during 2020, and where is it now relative to where we were before the first lockdowns in March last year. Instruments that the banks issue. So as you're aware, they'll start with their senior unsecured paper. Then they have the tier 2 subordinated notes, and then finally the additional tier 1 instruments, which is basically the equivalent of the new style preference shares that the banks are issuing. And you can see that these instruments have there was quite a strong repricing during that for that first month post lockdown, if you look between middle March to middle April, and that's really when the spreads peaked. And we think there were a few things here. I think firstly, on the senior unsecured side, I think there were some concerns around the impact of non-performing loans on banks and their liquidity, etc. But I also think there were, quite a few fears on portfolios that were holding that paper around, is there sufficient liquidity in that underlying portfolio? And our sense was that managers were liquidating the bank instruments because they are the most liquid. And as a result, the bank senior paper sold off, let's call it sold off first. And then on the subordinated instruments, obviously it's a higher yielding instrument, it's a higher risk instrument. And what you had was, we think it's not just the traditional sort of credit investors that held those instruments. We also think that quite a few of the multi-asset funds, ballast funds, held these type of instruments for yield pre the COVID lockdowns, and that really did speak to, I suppose, equity maybe not performing in line with expectations, quite a bit of volatility in the government bond market. So where did managers go and look for that pickup to offset some of that other uncertainty? And when we had that massive sell-off in equity markets towards the middle of March, April, and we also had the government bond yields rising, I think there was quite a few managers that actually had to sell these instruments as well to rebalance. So I think there was quite a lot of, I wouldn't say forced selling, but there was quite a lot of quick selling on these instruments, and that obviously led to this massive repricing. Now, taking it from sort of the middle of April to May, and you can see that that's really when spreads started peaking and slowly started drifting back down. And I think the one major factor there was obviously on the bank senior unsecured side, where, as I mentioned, there was a very low issuance. So all of a sudden you had a very strong supply-demand mismatch, and we saw a very quick tightening of credit spreads in bank senior unsecured space. And you can see it's actually now, and since sort of the end of August last year, it's actually been trading at levels where it were tighter than where it was in the middle of pre the first lockdown. And we can see the same with the tier 2 and the additional tier 1 instruments. So again, it is quite a you can see these are definitely priced to levels close to where they were, especially on the additional tier 1 side. And we expect the tier 2 subordinated instruments to also start, to continue to tighten further to where it was pre-COVID. On the next slide, we just looked at, different sectors relative to the bank senior unsecured, which is the gray line. Just here, I think it's interesting to see the insurance, the green line is the insurance subordinated instruments. They also repriced quite quickly in line with the bank senior unsecured, and we think it's similar reasons to what led to the sell-off in the bank subordinated instruments, and that's been sort of trending back down. And then you saw credit, the other sectors started to reprice probably a little bit later, and I think that was as investors became a little bit more confident with the liquidity in their portfolios, and they started looking at, well, these are less liquid instruments, but we do need reprice for risk in this credit environment. And you can see that the spreads did peak you can see that sort of corporate spreads did peak. And they've been trending lower, and we're starting to see this trend, especially in the high quality and the large industrial corporates, and that speaks to sort of the type of issues that we have in the South African market. It really is your large blue chip corporates such as a Bidvest, etc. And these businesses have, because they're so diversified, they've pulled a lot of levers to try and impact that earnings impact. And that really is one of the, we've seen the businesses, they were that low gearing going into COVID, that lots of liquidity. So they've been able to weather COVID quite well. And, as a result, their financial performance hasn't been as heavily impacted from a credit risk perspective as one may have expected. I think the two sectors that stand out slightly is obviously the blue line there being the SOCs. Just bear in mind that these are all floating rate instruments. So this is mainly the DBSA and the Industrial Development Corporation. I've removed Land Bank from this chart because otherwise it would be a very, a much more or a much higher level of repricing. And this is just to show that, when there was that Land Bank event of default, you could see how SOC spreads started tightening, and it hasn't really come back. And that really is just a concern around, I think there's an ongoing concern from investors around the sustainability of some of the SOCs. And then the other sector that has been struggling is obviously on the property side. We did see some issues such as redefine and accelerate approach note holders or bond holders for some relaxation of covenants, which they did receive. And I think there's concerns there just purely because your covenants, if you think about it, it's loan to value. So if your debt has remained stable, but you're uncertain around how the valuation of your property is impacted, and whether it's, you know, whether these impacts of vacancies and these you know, lease reversions, etc., if that's priced into your value or not. And I think that's where the concern is we, you know, there is still probably some concern around, you know, where is the floor for property valuations? So what is the true gearing in these entities? What's the ability to continue collecting rental if you've got rising vacancies, and how does that impact your interest cover ratio? And then also, if you are looking to sell assets, or are you able to sell assets, and at what value if you do need to sell assets to de-gear the balance sheet? So I do think those uncertainties continue to plague the real estate sector to some extent. So this really is sort of an update around spreads. Where were we? Where are we now? You can see that majority of the sectors are tracing back to where we were sort of pre-COVID levels, except for obviously the SOC sector and property. Just then, and almost through this segment is just to look at, well, what has issuance done, new issuance, and to see, well, so the secondary market tells us that spreads are contracting. What does primary issuance tell us? And again, here, what we've done is just taken a look at what was the issuance level, what was the issuance spread for the issuance you know, the last issuance pre-COVID lockdown, and what has the issuance trend been following the markets opening up. And I think two very telling you know, charts are on the left. Probably the second one, which talks to the tier 2 instruments, and you can see there the issuance sort of shooting up, or the spread issuance shooting up from JIBAR plus 213 basis points in Feb 2020 by ABSA to JIBAR plus 385 basis points by Nedbank in June, in the 30th of June. Sort of, what's that, 4 months later. What we have however seen is that at the end of the year, we saw Standard Bank coming to market, issuing at JIBAR plus 260, which is, you know, much closer back to those original levels. And we actually saw Investec Bank also issuing at 260. Now, typically Investec is between 10 and 20 basis points wider than the likes of Standard Bank, First Rand, and Nedbank and ABSA. So you can expect that the next tier 2 issuance which is actually by First Rand, would probably be slightly lower than the 260 that Standard Bank placed at the end of November. And then on the additional tier 1 side as well, you can see sort of from 425 pushing up to 495, and now back at around JIBAR plus 440. Standard Bank actually has an issuance coming up this week, and I think it will be interesting to see where that clears. Also expecting it to clear a bit tighter than the 440, just to follow that trend of tightening. I think what you also see on the right-hand side, on the industrial side, is that you know, as the market opened up, we saw quite a lot of corporates issuing in the 1 year and 2 year space, really to manage their upcoming debt maturities, and they were willing to pay up for that on credit spread because of the lower base rate. But as the market sort of settled from around you know, from around June, July onwards, and also towards the end of the year, we could see that you know, corporates started issuing in the 3 year space again. And what was quite interesting is on the auction side, the last 3 issuances there by CUP in October, Supergroup in December, and Barloworld now in Feb, you can see how the issuance spreads have tightened in that sector as well. Then on the property side, again, just looking at some of the issuers, I think what is interesting is we saw issuers such as Fortress and Equitas being quite favorably viewed in the market for issuance, and that really is because of their portfolios being more exposed to the logistics sector. It's a sector that did a lot better in terms of rental collection, etc. So they were able to, you know, to issue quite a bit of paper in the market towards the, you know, in the final quarter of the year. And then we also saw, you know, some of the larger REITs such as Growthpoint coming to market as well. But I think here we continue to see a slight downward trend, but probably not as fast as we've seen in some of the other sectors. And this is my final slide on on the issuance. Probably here the most important slide, or the most interesting slide, is in the bottom left. If you look at the insurance sub-debt that was issued, so pre the lockdown, we had Mutual issuing 5-year subordinated debt at JIBAR plus 155. We had MML issuing at JIBAR plus 175 in the 5-year space. And you can actually see then the first insurer to issue subordinated instruments now following lockdown was Liberty, paying JIBAR plus 230. But then in November, you could see that sort of search for yield starting to come back. And so we saw Old Mutual and Santam actually issuing in the 5-year space below 200. And then Momentum this year coming out with another 7-year issuance. I mean, firstly, 7-year issuance is probably some of the longest dated issuance we've seen since the lockdown, since we've gotten out of the 2 lockdowns. And then for them to issue under 200 was also quite, I think it just shows that there is appetite for yield in the market. And that really is just because of the tight issuance environment, and I suppose the low cash returns as well. So if you look at these, if you look at sort of where we are, my favorite line about credit is really that it's not a risk-free asset class, but it is less risky and less volatile than other asset classes. So, just looking at I think where previously credit was, quite easy to give you a real return, just purely because of the real, or the positive real base rate. You're now going to have to be more selective in terms of understanding that credit. Your JIBAR isn't necessarily running at such a large real rate any longer, and it's your actual credit spread that now has to do the hard work for you. So you have to work very hard to find the right credit. You're going to have to work hard to properly diversify your portfolio in a market where there's not sufficient issuance. So you really are going to need to pull every lever that you can. And we expect issuance to respond to some of the demand out there, but I don't think it's gonna be a much stronger year in terms of issuance than what it was last year. We also think that you're going to continue to see more private placement than auctions, although auctions will increase as well. But I think the issue with the auctions is because you're going to continue seeing demand outstripping supply, and you're going to see a lot of private placements. I think auctions are going to be well bid, and they're going to generally be very tight relative to guidance, because that may be the only source of credit for some of the managers out there. So, I think on the first 2 lockdowns in the pricing, I think the market, probably if you look at the amount of repricing, the market did reprice to a level we haven't seen in a long time. I think what we are seeing though is it remains a risky environment. I think the risk of credit losses is probably less pronounced than what we were sort of when we entered into the first lockdown, because as I said, the majority of the banks are well capitalized. They have been conservative with NPLs. Your corporates are have low gearing, and so I think it's more going to be sort of single name issues that's gonna lead to, I suppose, credit losses and spread widening. So that's just on the market. I think the next one is just going to speak a little bit about what happened at the Land Bank and just sort of the events that led up to that. So just broadly, I mean, a debt instrument, how does it work? A debt instrument is obviously is a legal agreement, either through a loan agreement or a domestic medium-term note program pricing supplement, where the borrower makes certain contractual commitments. These include servicing its debt, performing in line with certain financial ratios, servicing its capital when it falls due, and there's a number of other items there, but that's sort of your main items. And if the borrower doesn't do that, or the issuer does not do that, then you are, then there's an event of default, and you are in a position where lenders have to either look to restructure the debt, or they have the ability to enforce their rights and go and demand for the settlement of the debt. But what you typically find is that, you know, if all lenders had to go and enforce their rights, you're going to create a massive liquidity event in a company. And typically, you know, in the South African market especially, lenders opt to try and restructure the debt to achieve an outcome that works for, you know, for most parties. We also believe that it is you get a better outcome in a going concern restructure than if you apply for the liquidation of a company. So what happened so what can cause an event of default? So there's two types of events broadly. There's firstly something that could be a liquidity issue. So this is when an issuer or a borrower is unable to meet its contractual interest and capital repayments. The way you can start seeing that is your interest cover ratio. So your earnings relative to your interest bill starts reducing. Your free cash starts reducing relative to your interest and debt capital service. And then on the financial side, if you're looking at banks, for instance, your funding relative to your long-term assets start reducing, and you start having lower liquidity coverage ratios. So you start having pressure in terms of having sufficient assets to cover your 30-day short-term cash flows. I mean, one of the main causes here is obviously declining earnings, but I think then I think another one is obviously if you run a funding mismatch, so you've got long-dated assets, but you're only able to raise shorter-dated funding, then you're always going to be at risk of refinancing when your debt falls due, and that is quite a risk. And then finally, I think something that can lead to liquidity issues is obviously governance weaknesses. And we saw that with a large number of businesses, be it Steinhoff, African Bank, the SOCs, etc., that if there are governance concerns, investors become hesitant to provide the funding, and that could lead to liquidity issues because you're not able to refinance your debt maturities as and when they fall due. Next, you can look at solvency issues. So there's technical insolvency. Is obviously if your liabilities are greater than your assets. What you see there is your debt to your earnings start increasing, your debt to equity or CAR starts increasing, and that's again, it's caused by a declining asset base or increasing debt, and again, declining earnings. So your equity value starts eroding. I've got a question in the box, so thank you for that. I think primary source of defaults in SA names over the last 5 years. I mean, there hasn't been many defaults, right? I mean, I think probably the two most high profile, the three most high profile sort of credit events have been African Bank, Steinhoff, and the Land Bank now. I think if you look at African Bank, I think there was an overstatement potentially of the asset base. So it's something that was potentially a solvency issue. But I think that all came out of the wash very quickly. So you probably found that it was a combination of governance, a declining asset base, and then as a result of that declining asset base and concerns around governance, African Bank just wasn't able to raise the funding in the market, and they effectively ran out of runway in terms of getting the funding in. So then I think it is mainly solvency. But ultimately it led to a liquidity issue. I think on the Steinhoff side, probably something very similar to African Bank, where there was the asset base maybe was never as valuable as people thought it was, and when governance weaknesses spoke to that, it started catching up to the entity, and again you had the liquidity crunch. I can speak to Land Bank, which is I think this is probably the most topical, and yeah, it really was an issue of liquidity. We had key executives departing between 2018 and 2019, and they acted in, or we had that people acting in those roles for an extended period of time, with senior appointments only being made in sort of from February 2020 onwards. I think the other issue that the land bank had is that they had quite a large funding mismatch. So about 50% of their funding needed to be refinanced every year. It was an improvement from where they were sort of 5 years ago, and they did a lot of good work in terms of extending their maturity profile of their debt. But there was still quite a lot of reliance on shorter dated instruments. So, what happened was the land bank obviously had some debt maturities upcoming. They were busy doing a lot of work on getting those refinancing done. And then they started seeing, then there were some concerns around rising non-performing loans of the land bank. And that was really mainly as a result of that, of the drought. We saw that sort of in the Feb 2019 or the March 2019 and the September 2020 results. And if there's pressure on a covenant level, it immediately becomes difficult to refinance because you're not sure if you're refinancing into a default or not. And I think that slowed down the refinancing process. Then the land bank had a rating downgrade, followed by the South African sovereign rating downgrade in March, and the onset of COVID. So what you had is, yes, you had the government providing you had the government providing a government guarantee that could be used to raise funding, but you had pressure on the covenant. So you were concerned that, well, if you're advancing and 3 months later you are sitting in a default position, and then you've got all the other stresses of sovereign rating downgrades and the onset of COVID. And I think what that resulted in again was the land banks running out of time and getting those loans refinanced. So yeah, that's where the default happened. There was a payment due on a revolving credit facility that they couldn't meet, and as a result, they defaulted, and all the debt had cross defaulted on that as well. So essentially, all creditors still to this day have the rights to approach the land bank for settlement of their claim. I think to date, lenders have been constructive, trying to work out a plan in which to sort of operate and keep the land bank going, and also maximizing the recovery for our investors. There's a lot has been said about the response from the government and the land bank, but I think there has been a response. It's debatable where it's sufficient, but there's definitely been a response from the government, and I think in many cases it's seen as in my view, it's been actually a relatively strong response. It's not perfect, but given a very strained and tight fiscal environment, they've definitely done quite a bit. So obviously senior managed positions have been filled. To date, they've kept the commitment that all creditors are to be treated fairly, and they've adhered to date. I know there's some concern around that going forward, but that's something that will need to be addressed. And then what they have done is they've caught up on all interest. They went through a couple of months of not paying interest. They've put a lot of liquidity levers in the business in terms of running their book down, generating cash from the book as it comes back to them, and they've used that to essentially catch up all the interest that was deferred. So they are up to date on all interest payments. In addition, the government put 3 billion rand into the land bank towards the back end of last year. So the cash generated, along with the 3 billion rand of cash that came in, allowed for the land bank to pay down 12% of its debt. That was paid down at par to all funders, along with the accrued interest on that. And then obviously the government announced a 7 billion rand recapitalization in the most recent budget. So what if you put that into perspective, the equity value of the land bank was the 10 billion rand is more than double what the equity value of the land bank was before the event of default occurred. So it's a meaningful recapitalization of the land bank relative to its size and relative to the fiscal strain. But again, it is time will tell whether it's sufficient. I think is the broad view out there. So what are the recovery prospects? I think we've had some negotiation setbacks over the year. I mean, obviously it started off with a partial guarantee being on the table that was then no longer available, and that was as a result of the National Treasury being more being a lot more discerning in making government guarantees available to SOCs going forward. And there's a lot more conditionality to that. So unfortunately, it seems that that's something that impacted the restructure at the land bank. And as I said, there has been a commitment of a 7 billion rand recapitalization. It's 5 billion rand that will come into the land bank this year and another 1 billion rand in each of the following years. I think there is where, I think there's some conditionality to that funding coming in. There's some allocation of that funding that may be problematic for some funders, feeling that not all creditors are being treated equally. So, those are some of the challenges we are facing. I think we're working through it. At the moment, I don't think it's in anyone's interest to start a run on the land bank, because I think that will just trigger a massive liquidity event. That will prevent the 7 billion rand from coming in, because you can't expect the government to put 7 billion rand into an entity that is, that is experiencing a run on its book. So we'll have to, I think there's still quite a bit of work to do. We'll continue to do the work, but I think it is important for lenders to remain unified in terms of how they approach the restructure. We'll see how that goes. So that's my presentation. I've tried to leave a bit of time for questions. So if there are any questions, happy to take them. Albert, I don't know if there's anything you want to add from your side.
Hey, Corneleo. And there's not much that I want to add from my side. There is a question or two coming through. Let's just see this first one. Maybe you can have a stab at that question, Corneleo, and I'll comment after you.
So, Albert, the only question I've seen is on the okay. So I see there's a debate on whether. Sorry, I'm missing the last the questions. If you could maybe read it out to me.
Okay, so there seems to be a debate around whether yields on offer from credit are adequate enough to compensate for credit risk, compared to rather investing in the bonds, for example. Apart from diversification, is it worth taking credit risk when yields on the first rank credit is lower compared to the R186 when considering credit risk?
Yeah, look, so I suppose that's an asset allocation decision. And I think it's something that's very mandate specific. I think there are some benefits. There are definitely corporates that are issuing credit that have quite a diverse geographic reach. So you are potentially getting a little bit of diversification away from the SA market, from what you would expect in the normal bond market. But I think it comes down to what you want your credit to do for you. If you are looking for something that's, I suppose, less volatile than the bond market, but still gives you, in the current instance, a slight real return. If you're looking to make your cash work a little bit harder, and you want to try and eliminate the drag of cash on your portfolio, I think there are still selective opportunities in the credit space. But yeah, I think it comes down to asset allocation at the end of the day.
Okay, so from my perspective on that question, it's and let me just, if you don't mind, give me a second so I can turn on my camera so people can see me. So from my perspective on that question, it's an interesting one, because from an asset allocation perspective, Cornelio's right. We are underweight credit in most of our asset allocation portfolios. But that is primarily a function of the base rate, JIBAR, rather than the credit spreads themselves. There are actually a couple of portfolios where we have the capacity to be a little bit more creative, where we do actually utilize both credit and do a type of trade, which they do a portable alpha trade. Now, a portable alpha trade is where we effectively take returns from one asset class and transport the performance profile of that to another asset class. Within Ashburton do this quite often within the credit and bond spaces. Now, what we do in this case is we buy a range of credit, and that gives us a JIBAR plus a spread outlook. The portfolios where we do this on, it's probably around about JIBAR plus 250. And there are quite a couple of names that are actually giving you around about JIBAR plus 250. We actually saw a very large name this morning, which where we could get a JIBAR plus 250 spread. So the spread is relatively attractive. The problem within the credit space, at least relative to bonds, is the base rates. It's the JIBAR portion, not the plus 250 portion. So what we do is we effectively do a swap. Right now, there's a lot of different swaps you can do. You can go fixed to floating. You can go cash to bonds. You can do a range of things. But for example, in this specific case, we do two different types of swaps. One is we do an all-B swap. So we pay JIBAR plus a spread, in this case about plus 70 points, and we receive the all-B. So what we effectively do by doing this is we transform a JIBAR plus 250 base to a all-B plus 170 return profile. Or in the case of the R186 that you've mentioned here, we have you change it to from a JIBAR plus 250 to a R186 plus 170, right? Now, of course, it's important to note here that you get returns here because you're moving from JIBAR to bonds. And that move has a return element to it, but it also has a volatility element to it, right? Stable income and money market and these JIBAR portfolios have been very nice and stable, has been very nice and flat over the last couple of days and weeks. However, bonds have been selling off significantly the last couple of months. In fact, this morning again, bonds are down between 1 to 2%, depending on where in the curve you are. So yes, the yields on these assets are looking attractive, but you do get significant volatility in those asset classes. That doesn't mean that we don't necessarily like them. And the comment and the question we've seen here is that we tend to still prefer bonds and linkers over cash, but there is a significant volatility element that you need to be at least willing to stomach over a shorter term, even a short-term, medium term, to be able to get those return numbers. Where we expect something like stable income to give you 5.3 to 5.6 over the next 12 months. We expect your diversified income funds to give you between, well, with bonds where they are now, so probably between 7 to 10%, depending on what bonds do. So you are likely to benefit from it, but there is a significant degree of risk there. Okay, let's see. There's another question here. Just Corneleo, maybe you want to add something?
No, Albert, I think you've covered that.
Okay.
I think the next question is probably for you on your view of US yields.
So US yield are a fascinating question because it's one of the most discussed things at the moment, and there's two primary camps. One is the inflation camp and one is the deflation camp, and there's strong arguments on both sides. One is that deflation and disinflation is going to be a global and US phenomenon going forward, like it has for the last decade, and that any inflation increases we see will be transitory for a range of reasons. One being the fact that central banks want rates low. Another one being that the significant improvements in technology is inflationary. Three being the fact that demographics in China, US, Europe, etc., aren't great. And where you used to have a population pyramid with each generation significantly larger than the previous one, that's no longer the case. So your dependency ratios are higher, which means suddenly you have to push tax rates up, etc., do more deficit spending, etc., right? So those are all reasons why people expect the deflation. From the inflationary camp, you have the case that says, well, there is once again significant, massive expansion in the monetary base. And the Fed this time around is much more blasé around inflation expectations. They're in fact trying to push up inflation expectations with everything from their rhetoric to the way they purchase assets. So those are the two camps. I think that the Fed wants rates and US rates to be slightly higher than they were last year. I thought that the 1.6% we reached about a week or two ago was a relatively decent level for the US 10-year. We peaked Monday and last week at about 1.75, right back at 1.65. I don't think that US rates are going to, for argument's sake, 4%. The current financial system can't stomach it. You'll see waves of default, which will derail all the efforts of the Fed in trying to push money into the system. But I think it's potentially likely that you could see let's say a 2% rate on the US 10-year. But I think for now, at least, we've kind of reached a level that is at least sustainable in the short term. And we're going to have to see inflation being realized in the US over the next couple of months before that it gets tested significantly. So probably 1.6 to 1.8% in the short term, potentially 2% in the medium term. Unlikely that we'll see anything above, say, 3% at least for the next year or two. But it's unfortunately one of those things where there's very, very strong arguments towards both ways, and it is a view that you need to take into account. You need to make sure that you're hedged properly for the set of circumstances should it happen, should inflation come through, and should we see a 4% rate on the US 10-year. And if that happens, value stocks will do better than growth stocks. You'll see things like gold, for example, do maybe a little bit better, etc. There'll be a range of other things, but it's going to be an interesting set of circumstances. It's not our base case at the moment. At the moment, our base case is that US rates remain, let's call it between 1.6 and 2%. But I mean, we reassess that every month, and we'll have our next investment meeting in 2 weeks where we will reassess that again. Any other questions? Okay, it doesn't seem like they are. Firstly, thanks, Corneleo, for the presentation. We appreciate it. And thanks for all the help on the credit books and within my portfolios and the help that your team does and all the great work there. Cornelio's team does a gargantuan amount of work. They cover twice the number of credit counterparties that's listed on the JSE. So there's significantly more work being done by them than a lot of other credit teams in the market. Just by the value of the number of names they need to cover. That makes my life a lot easier. Thanks for everyone else. Okay, a question here on FUFY. Just a quick question on how does gold go up if your US rates go up? It's potentially an inflation story, right? So the best hedge long term, or one of the best hedges long term against inflation, has been gold, right? The fact that it depends on why rates are going up, and if it's because the Fed has lost control of inflation, one of the traditional hedges to inflation risk has been gold, right? Because your monetary base erodes, real assets like gold, property, etc., agricultural assets, commodities, those kind of things tend to do well. If it goes up for other reasons and it's not an inflationary one, so let's say for argument's sake US rates go up as a result of fiscal concerns, but inflation stays under control, then gold doesn't do well. So it's a function of an inflation blowout pushing up rates, but also pushing up pushing up gold and other real assets at that time. So the primary mover is inflation, not US rates. Both move as a result of an inflation spike, rather than the primary mover being yields moving up as a result of fiscal issues. So thanks, Corneleo. Thanks everyone on the call for your time. If you have any questions, please reach out to the Ashburton BDMs. I hope that you know who they are. If you have any further questions on any of this portfolio specifically, or any other fixed income questions in general, for either yourselves or your teams, please let us know. A couple of years ago, we have often run fixed income seminars on specific topics. If you are interested in some of those, please let me know about that as well. And as well as any other feedback on today's presentation or anything else you might want to hear about next month. Have a good day and a good week, and we'll talk again soon. Goodbye.
Yeah, thanks.